The price of gold fell sharply on Friday as Federal Reserve Jerome Powell announced that a quickening of Fed tightening is appropriate at this time. We're here to discuss gold's next move and Fed monetary policy with Phil Streible, Chief Market Strategist at Blue Line Futures. Welcome back to the show, Phil.
Yeah, thanks for having me on, David.
Yeah, tumultuous day in the markets today as gold dropped more than 1%. We're speaking today around 2:30 Eastern time. First of all, do you think gold's drop was solely in response to Fed Chair Powell's comments during a recent meeting? He said yesterday that because inflation is high, it's appropriate now to quicken the pace of tightening.
So inflation is much higher now, and our policy rate is still more accommodative than it was then. So it is appropriate, in my view, to be moving a little more quickly. And I also think there's something in the idea of front-end loading whatever accommodation one thinks is appropriate. So that does point. That points in the direction of 50 basis points being on the table.
Yeah, they are going to tighten it much quicker than what was anticipated. Bear in mind that we don't have the stock market completely fall out of bed or the economic conditions significantly deteriorate. Now, people were really concerned about, if you look at last week, gold and silver ended up on a high note. And then we kind of peaked on Sunday night into Monday. And then we've been in a perpetual sell-off throughout the entire week. So I went and I looked at the interest rate hike expectations from last Sunday coming into Monday until now. And we had actually leveled off and started to come down. So they were only anticipating like 8 rate hikes coming into last Monday. And it looked like we were going to back off. And then since those comments, we shot up. We're at about 9.96 25 basis interest rate hikes by the end of the year. So that is definitely going to put some pressure on the market.
So how many interest rate hikes you said?
9.96. It's just under 10 because there is a chance that they won't hike on one of them. It's 9.96 25 basis point interest rate hikes. So when you do the math, you multiply it out, it puts it at 2.5%.
There's not even 9 meetings this year. So there's going to be intermeeting rate hikes?
No. Yeah. When you start talking about 25 basis points, so every time they raise 50 basis points, that's going to be two of those 25 basis points. That's how they do the math. That's how the calculations work. So it's all based on quarter basis points.
Next meeting's coming up. Are you expecting a 50 basis point hike then?
Yes. They are starting to elude some of the Fed officials of a 75 basis point. That would really rock the boat, and you would see, that much harder landing than what they're trying to prevent.
Yeah. Okay. So gold's not taking this news well. Gold is factoring in the possibility that inflation is not going to rise as quickly as the pace of interest rate hikes. I suppose that's why gold fell. Am I correct?
Well, if you look at inflation actually will level off and over time will start to come back down. You're going to have, it might take a full year for it to happen. Like you're going to have farmers planting and things like that. We'll get through some of these supply chain issues, and we'll resolve, like you'll see crude oil prices, they didn't make a new high. They're not over $140 a barrel. You look at lumber prices have come down, but businesses want to make money. So they've got some catching up to do. So there's a lot of different angles. Businesses are actually creating inflation by raising their own prices, although the price of the underlying raw commodity has come down.
Okay. So what is your view on inflation then? Do you think we'll continue to see higher CPI or have we peaked?
Yeah, we'll peak. We'll peak in this last one or the next one will have peaked and will start to come down. Like the CRB index will start to come off of there as well.
Doesn't look like it's a great environment for gold then this year if we have inflation peaking and interest rates rising. So interest rates should rise. Yeah, sorry.
Well, if you look at gold and look at the price action this week, again, like I said, the interest rate hike expectations went up. Gold prices had come down. The gold had also, if you look at the S&P 500, just like today, for instance, the S&P is down 100 points. This is as of, this viewing. Dow's down 800 points. NASDAQ's down 300. They're breaking significantly, right? Earnings per share growth is coming down. So I did some, looking under the hood on like who is owning gold and silver right now. And it seemed like you had a lot of investors that are not traditional gold and silver investors, people that are more general stock market people. They saw that Ukraine Russia conflict, and they had started to speculate in gold miners, silver, and anything else they can. And I looked under the hood at the latest CFTC non-commercial net long positioning. And if you look at silver, for instance, silver, the 1-year average of non-commercial spec longs is 35,000 contracts. Right now, we're at 46,000 contracts. When you get the S&P falling 100 points, those extra 11,000 contracts, those people they are not your traditional silver holder. They're going to liquidate it. And the baby goes out with the bathwater. Same thing with gold. There's 44,000 extra longs that from the 1-year average. So you've got a lot of excess speculation in the metals markets. And I think that's the reason why we're seeing more of a correction today.
So are we net short or net long? Can you just clarify there?
Yeah, we're net long. We're net long on gold, net long on silver, net long on platinum as well. Same thing on copper. Nothing is really standing out. It's just there's more speculators in there. Something else, too, is that you saw some of the mining stocks got hit today, like Newmont Mining down 3.5%. They missed on the top and bottom line. You have people that, they associate that with they'll buy Newmont, they buy GLD, they buy GDX, they buy all these things, SLV and everything. All of a sudden, one of those stocks gets hit in their portfolio and they start liquidating everything. So what I'm saying is that this is more like they poured you a cappuccino and this is the froth that is just getting cleaned off right now. So that's what I think is coming out of gold and silver right now. And if you look at the daily chart on gold, it's been 1920 has held significantly. I don't want to jinx it, but we've come back down to we're getting close to that 1920 level. And look, we've been cycling between 1920 and 1960. Most of the analysts out there are pegging 1950 as their average price on the year. So I think that this corresponds with everything.
All right. So are we due for a washout then in the price? If you're saying that the average outlook is 1950, well, what are we at now right now? We're pretty much close to that. And you're telling me that the outlook is not, terribly great for gold, although we are still net long. So I'm getting conflicting messages. What's going on?
So, what I'm saying is we are at gold prices like those $1,700 golds, sub like 1850 golds. I just don't see those now anytime.
You don't see 1700.
We're at the higher level. We don't have the makings for like another run at the contract high. So right. I do anticipate more sideways action. Something else that, you got to look under the hood, because like half my day is spent trying to basically go through different news articles, different things that cover precious metals and see if there's any validity to them at all. One of the ones I saw today was, hey, dollar index breaks out to a new high and that hurts gold. So the dollar and gold over the last half year, they've been about 80% positively correlated. The dollar goes up, gold goes up in a day, and they work together.
Is that because of Ukraine?
It has been, but it was really the interest rate hike expectations going up that strengthens the dollar. Okay. And then also they think that affects the economy, slows it down. So that's why gold goes up as well. Now, if you look the last 30 days, it dropped down to 0.62. You look at the last 15 days, it's 0.58. You go to a day like today, now it's going to be more like, it's not inversely correlated, but the strength between the two, the argument to say that the dollar's going up and gold are going up together is not as strong as what it was 2 weeks ago.
There's talk of stagflation finally hitting the economy. Well, technically it kind of already is, but because the economy has been slowing down and inflation's rising. But should stagflation continue to a more serious level, that could potentially lead to a recession, which could be, I guess, positive for risk or safe haven assets rather, like gold.
You have different like pockets where you get stagflation. Stagflation is declining growth and rising inflation. So in certain cases, it's out there like, in the corn world, stagflation, definitely. You got, decreasing demand for things, and then you've got rising prices underneath. But if you take a look at, other commodities out there like platinum significantly off of its highs. Palladium significantly off its highs. So there's areas where you have disinflation, where the inflation's not up and the growth is starting to stall. I think the Fed, in the long run, what happens is the Fed will over-tighten right out the gate. They'll create kind of panic in U.S. equities. And then from that point, you'll start to see things level off. So I think gold and silver, they're going to have another run. The silver market needs to go up. It needs to.
What about global growth, Phil? What about global growth? The IMF came out with a report recently. They've reduced their global growth outlook by 0.08%. So are we headed for a slowdown? Do you agree with the IMF?
Oh, 100%. Global growth is toast right now. There are no countries that are accelerating by any means, especially with them increasing, sanctions against Russia. They have their own individual situations. Look at China. They're back on lockdowns. Their growth is slowing so bad and their inflation so high, they can't even be more accommodative right now. If they do that, that's going to be a train wreck. That's going to propel inflation higher. So growth globally has to slow down. That's why you start looking at, like, one of the stock indices that we track that we don't necessarily trade is that MSCI emerging markets. That thing looks like a dog right now. And I think that is a good reflection of the global economy.
Okay. So you're looking at what, 2.5% in terms of rate hikes this year in total. What's that going to do to inflation? Will that do anything?
The thing that that cures inflation, they always say higher prices are what kills the demand. I think that the game that they're playing is that you raise rates, the housing market, which has been on fire, will start to stall out. Like, the biggest expense that people have is their housing, their rent, and their mortgage.
Yeah.
With those increasing, because a lot of people did relocate and things like that. And with these higher prices, people are going to start to trim and they're going to start to cut how they were spending money. And that's where I think that the inflation starts to come down. Plus, a lot of these different pockets and things like that, they will be solved. Like, oil will be, I don't think we're going back into the 60s anytime soon. But I just don't see that run to like 140, 150 again. Some of these like shocking numbers.
Yeah. Well, okay. So a couple of points that you've made. First of all, you're right. I mean, housing is getting more expensive. Mortgage rates, I read this morning, are at a 12-year high. 12-year high, Phil. That's a lot. We're way beyond pre-pandemic levels now, multi-decade highs. But to your point about people not spending because of all these other excesses slowing down, like mortgage rates going up, the discretionary income going up, keep in mind that we had inflation during the pandemic when everything was shut down. There was no demand, yet because of supply issues, prices had to go up, right? So it's not always a demand issue. Aggregate demand issue is what I'm saying. Do you agree with that?
I agree with it. I mean, you look at, so like, I had a conversation with like a restaurant owner yesterday, and I told the guy, I'm like, hey man, he was complaining about inflation. I said, why don't you just raise the price of the, the entree, a buck or two, I'm still going to go there. The guy goes, Phil, we already did that. We've done that twice already. He goes, now we're worried about, they're trying to figure out like to cut gas down and, reduce AC spending and things like that. So businesses are really, you're not going to see small business growth at all. And I think that this whole inflation thing, I think a lot of these places, they really tighten things up in that growth does slow from that aspect. The only businesses that are going to be able to do well are the ones that can continuously pass the buck on to other people. Those are the stocks that you'd want to be long, but I just don't see, there's not too many of them. And I think that those businesses also reflect how people are. I mean, I could tell you, if my mortgage rate was 5.5%, I would have a tough time even, buying a place like where I live right now. Yeah. And that would definitely impact the decision on whether or not I fixed my old car or I bought a new car.
Okay, just real quick on housing. One of the issues with 2008 was that variable rates ticked up faster than people expected. They had to default. Could that happen again this time?
I don't think that they have as that situation back then. I mean, people were just basically lying. They had the variables and stuff like that. I just don't see the qualifications of people. I don't think that that's a mortgage that's floating out there that much anymore. Seems like everyone's locked in 30-year fix, 15-year fix, and the amount of due diligence that a mortgage company does right now, it's almost invasive or intrusive on they're really looking under the hood as far as your finances if you can afford a house now.
All right. So how are you trading gold now? Given your outlook, give us a price target and how you're playing it with
I can tell you,
futures,
we scaled in on gold. We were slightly early 1945 on this last round. We picked some of those up yesterday. We're adding some more between 1925 and 1920. From that point, we're going to wait and hold and see if it's just the same exact bounce that's going to happen. We'll go back up to 1965, 1975. We'll let one out. We'll wait a day or two, see if we're going to break out to the new high. We'll see if the Fed somehow says something or more of a meltdown occurs, geopolitical risk, whatever. Silver, that's another one that we're starting to scale in. We picked some up here, 24.51. We're a little bit behind on that one as well. Platinum's another one we're looking at. We had a great seasonal recommendation that ended last week on platinum. We took profits on that. We're starting to scale back in. Since then, platinum's fell $70 per ounce. So the CME also is launching a new copper contract. So with copper down below 460, I think I really like that as well.
Mm-hmm. All right, Phil, fantastic thoughts. Thank you so much for your update and for coming in on Friday. Enjoy the rest of your afternoon.
Yeah, thanks for having me.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.